So where is the local San Jose real estate market headed? What's going on with the economy and how's that going to affect real estate prices? I know the news headlines are full of gloom and doom, so stay tuned as we talk about the 2023 real estate market forecast for San Jose. I'm Theresa Wellman with HomeownerExperience.com. We love working with you guys and answering your questions, and we're currently helping buyers and sellers work through these questions of what's best for them and what's the best timing for them to make a move. So if you could use our help, feel free to text us at 408-839-4196. So let's go ahead and get into the actual data. Today we're going to cover the closed stats for November 2022, talk about the market going forward, bring in some experts of what there are slides from experts that I've been researching on what's going on with the national economy and market and how that all boils down to our local market here. So we've got a really loaded video for you today. Let's look into the charts. So here we are with our Santa Clara County chart that I typically start with. What I really want to point out, and we talk about this every month in these market update videos, is supply and demand. So the news that you hear is usually national or statewide, but really what matters in the real estate market is micro markets and local markets. So we're going to start with Santa Clara County and boil it down to San Jose. And of course, we can get into local areas if you want one-on-one. So that's what we're here for. So today, the supply is relatively, I'm going to say somewhat normal for November, right? It's definitely dropped. We didn't hit a peak anywhere near the normal for this market, but definitely higher than what we saw in the pandemic, which was, as you know, very unusual market. Demand has dropped, and I think interest rates are playing a huge factor to that, as well as just a seasonal time when buyers are definitely taking a step away from home buying. So let's step back and look at the actual market and what's been going on in Santa Clara County. So if you're new to joining my channel, this chart I bring up every time because I start here since I have data since the year 2000. This is data that I've gathered in my career over time. And as you can see, this yellow inventory line during the Great Recession prior to the market crash was so high. And in the recent years, we've been nowhere near that. So that's one factor that we're definitely keeping an eye on is the inventory. Demand is the other. You can see in 2007, 2008, the demand was way down because of what was going on in the economy. And I know there's a lot of uneasiness in the economy as well, but our demand is not as low as what we saw back then, for sure. Look at this change or the trajectory of prices. From 2009 to 2012, we had a very modest overall appreciation with the seasonal bumps in the year's time frame. Then when we hit 2013, the slope of that curve really changed. Now we had a little rocky time in 2018. Interest rates went up quite a bit, not as much as they did this year, but went up quite a bit. Inventory went up back to more normal and it really slowed the market down. So prices did adjust a little bit. And then in that pandemic years, we saw huge appreciation again because of supply and demand. Do you see the theme? So let's talk about the actual national economy and what we've been coming from. So the after COVID economy is what I'm going to call it. So things that we know, inflation has been very high. Interest rates have doubled in less than a year, and that is as the federal government is trying to get a handle on inflation, albeit a little bit late, so they had to come on really hard, and that has definitely affected the real estate economy. Gas prices are up. Layoffs have recently started to happen, so that means unemployment is going to rise. So this is something we're really going to want to watch locally. How high does that unemployment number go? Because that will affect buyer affordability and demand and the inventory. If people lose their jobs, they're going to put their homes on the market. So we're going to keep watch on that number. And the government, of course, has been keeping the economy afloat and moving artificially for several years, and they're backing that away. So the market is trying to find its new normal without all of that help from the government. So based on all of this, yes, the real estate market has cooled off this latter half of 2022. So now let's look directly at San Jose. The supply feels really low right now, partially because not a lot of new inventory is coming to market. The number of homes coming to market is very similar to what we've seen in the last several years. The difference is we're not selling as much and homes are sitting on the market a little bit longer. So our inventory is feeling a little bit stale. and looking a little bit higher as far as how we track it. Now, demand is definitely low, but not too far off for November. What I want to point out with this pink arrow here is the difference between the supply and the demand is really tight. So when we get to that point, or when it inverts like it did in the pandemic, where you see the green lines above the yellow inventory line, that's when we get multiple offers and intense price appreciation because of supply and demand. Low supply, high demand, people pay more to get the house. But what we've noticed is those interest rates obviously have really affected affordability. The huge increase from say 3 to 3.5% earlier this year up to 6.5+%. It hit 7 and it softened a little bit now. So if we just take a snapshot of the affordability for the peak market in March versus the closed sales in November, I want you to see these numbers because it's pretty eye-opening. So yes, the market has softened quite a bit, and we'll go into that. From the peak here in March, the prices have softened. But from an affordability perspective for buyers, what has it done? So if I take an 80% loan to value for the average price home, which obviously has changed over those several months, the average interest rate at that time, here's the payments we get. So in March, buyers were paying $8,639 a month for just principal and interest. And in November, they're now paying $10,044 a month for the same principal and interest. So as you can see, even though prices have softened, buyers are paying more. That's not a good sign, right? That hurts the market a little bit. And this is why buyers are a little hesitant right now. So let's look at the actual numbers. So today, for closed stats in November, the San Jose single family home price average was 1.4 million. Now that's down from last month, but we expect that in November for the prices to dip. If you saw that chart, every year has a hump in it, but we're down now year over year. If you recall or watched last month, we had a slight year over year appreciation. Right now we're down partially because last November and December was so hot. We didn't see the typical slowdown for the year. That's part of the reason why we're seeing that year over year drop. But it is, something to definitely keep an eye on moving forward. Average price, sales price to list price is below asking at 98.8%. So it's been a while since we've done that. And look, at a year ago, it was 10% over. And if you remember, it peaked in the spring of this year at 18% over on average. So definitely the supply and demand was very evident in this sales price to list price ratio, which is why I track it. Though we are only at 35 days of inventory, even with homes sitting on the market longer, we still just have over 1 month of inventory, which is not a lot. And if you check other areas of the country, this is extremely low. Definitely a big change from 9 days a year ago though, right? So we're in a much more normal Silicon Valley rhythm and market at 35 days of inventory. This closed sales are down, the inventory is up like we talked about a little bit before. What I want to point out is I know a lot of people get really concerned with the prices peaked. We talked a little bit about the affordability for buyers. So even though interest rates have gone up 2.5% to 3%, that would typically mean that a buyer's budget would be hit 25 to 30%. But our prices have softened 20% from the peak that we saw in March and April. So not that full 25 to 30% hit that buyers are seeing with interest rates. So keep that in mind. I'm not sure if that means the market will soften a little bit more, but there's other factors to consider, obviously, as to how the supply and demand are going to balance out. And like I mentioned before, November, December typically are lower sales and lower supply. So we can't really learn a lot from that, but we can keep watch as to the trends and what's changing in the next few coming months. So stay tuned. I'm going to go into some of the slides from experts that I listened to expert economists about the economy and the market and the housing economy. And then I'm going to give a local forecast for 2023 in San Jose. Okay, so back to the San Jose chart. I want to point out a couple things. Yes, we have a seasonal slowdown. Here's that bell curve you can see for every year. So these gray lines is the new year or January. So typically sales closed in January is the lowest point in the month. That means people went into contract in December are closing in January. That's usually the slowest month of the year. Also, the other thing to point out is inventory is usually the slowest right around there as well, right? So we are not quite as low in inventory, but this is closed November data, right? Not December data. We're just in the beginning of December now. We're not quite as low as we've seen the last several years, but if you go back into time, we're much more in line with that. So here in this 2018 winter, we're below that number. We're below all of these previous years here as well. We just are not below 2017 or 2019, 2020, 2021, which, that 2019 was or 2020 started off as a really hot year, and then the pandemic hit and kind of changed the trajectory of 2020 a little bit. But that winter of 2019 was pretty sparse and hot. So let's see what happens. When we have low supply with those years I pointed out, what happens to prices in the spring? So that's why I have these yellow boxes up here to point out. As you can see, we usually see a little seasonal dip for November, December, and then prices really take off in the spring. Look at here, there was no dip at all. Prices shot right up. Here there was a dip earlier in the year, and then December started to see a slight appreciation and then shot way up. Again, here there was no dip at all. It started to shoot up in the fall last year and just kept going strong until March, April. So as you can see, if we continue to keep low supply, the demand that turns on usually in February, March is gonna probably see a little imbalance, because for some reason, most sellers don't put their house on the market until March, April, May, but buyers are out shopping before then. So usually there's a little bit of a lag time and some overbidding and appreciation that happens in that early part of the year. But typically those buyers are getting a little better deal than the people that are buying in the spring, just because they're setting those new comps, right? The things we got to keep watch on from a forecast perspective for 2023, obviously supply, because that really goes on a lot of this. Demand, which is related to interest rates and unemployment. So we definitely got to keep an eye on those items. So here's what the experts say about supply. Now, obviously these are national numbers. This is from the National Association of Realtors. Inventory, you see this peak here, like we see in the Santa Clara County peak, was from 2005 to 2012, much higher than what's typical for the area. Now in San Jose area, we didn't see it, 2011, 2012 inventory wasn't that low. It was up to what we consider normal, or we've maintained that. But the point here is, nationally, inventory has been extremely low the last several years. And yes, it is up a little bit this year, but still way below normal. Okay, so we got to keep that in mind. And the biggest reason for this is the lack of new building supply, and the millennial generation, which is our largest generation, coming and aging into home buying. So more households being created and a lower supply of housing is just causing an overall national supply and demand issue. So let's look into California and narrow that in a little bit. California is definitely behind in the supply for homes, especially in certain areas like Silicon Valley, where there's a lot of jobs, wonderful weather, and people are coming here to live. So the population is really strong, and that is really affecting our demand and putting a huge pressure on the supply. So if we look back at 1986, there were 27 million households in California. 2021, it was up to 39. So yes, it did decrease a little bit. I think probably in 2019, we were maybe at 40 million or 41 million households. People have left California, but relative to 1986, we're still way up, right? Now, if we look at the housing permits or the new building, in 1986, we were at 256,000 new permits in California. 2021, just 115,000. So you see, these are going the wrong direction, right? When we should be building even more to satisfy the influx of people, we have actually been doing the opposite, causing a huge supply and demand problem in California. You might have heard me talk about this before. And interest rates are on the rise. You know that. We've seen this huge increase. If this is marking the very beginning of January at 3.22%, up until the beginning of November at about 7%. So huge, unprecedented, biggest year-to-date increase in over 50 years. So no wonder buyers are feeling the pain. As I explained, in the affordability, even with the price softening, buyers are still feeling that monthly payment is even higher than it was earlier this spring. And typically rates are going to follow inflation. So until we get that inflation under control, rates could continue to increase, because that's the Fed's tool to dampen the inflation and correct it. So let's look here a little bit larger perspective. This is interest rates, the 30-year fixed interest rate since 1990. As you can see, they were much higher in 89, 90, and they've overall trend has been down. And then in the last 4 to 5 years, we saw a huge decrease in interest rates. And then the government jumped in, I'll bet a little too late on inflation, and had to go in hard and throw that interest rate up so fast that we've seen, people kind of freeze and freak out, right? Let's talk a little bit about a recession, because I know people keep hearing recession. There's fears of recession. People say a recession is likely around the corner, probably is already here. We don't need to argue that. What I think you should know in this video, if you're talking about buying a house and what's going to happen in the housing market in 2023, you want to know, what does a recession mean to housing, right? So here's some data of 1980, 1981, 1991, so all of the past recessions. And as you can see, only 2 of them did prices go down. Obviously, 2008, they went down a lot because that recession was actually caused by the housing market and bad lending, which is not happening today. So we're not expected to see this by any means. And it could mean, because of our supply and demand problem, even with the recession, we're going to see a slight appreciation in prices. So it's going to depend on area though. Real estate is local. So let's get into that here in a moment. Here is what happens if a recession comes. Likely rates will drop. So that's good news, because that'll improve affordability for buyers, right? Here's a quote from an economist at Redfin. For those bearish folks eagerly awaiting the home price crash, you'll have to keep waiting. As much as demand is pulling back supply, it is as well reducing downward pressure on the prices in the short run. Supply and demand is really driving what we've got right now, right? So we got to keep that in mind. So nationally, there is a big range of what people expect for housing prices. National Association of Realtors thinks it's going to very modestly appreciate. The lenders, Freddie Mac and Fannie Mae, federal lenders, think it's going to go down slightly. And then there's other perspectives going opposite directions. So the news by experts is all over the map. Again, real estate is local. What I can tell you is the predictions from experts for 2024 is all positive. It's 2023, people aren't sure about. As we get inflation under control, how long does that take? How much do interest rates have to be risen to make that happen? Those are kind of some of the unknown factors that are really hard to predict for 2023 and what's going to happen. Okay, so prices take time to recover as the intensity unwinds and the market catches its breath after COVID, because COVID was an inflated government-maintained market, and the government has removed that support of the economy and people's finances, and so we've got to find a new balance. So ultimately, I'd love you to watch my video of where is the market going. I did about a month ago, maybe 6 weeks ago, where I talk about the history of Santa Clara County and some of the actual numbers. When I work with a home buyer, we really go into your plans and how long you plan to stay there, whether it makes sense for you, what size of home makes sense for you. Because my advice is always to wait or to hold a home at least 7 years, or to buy a home that you can live comfortably in for at least 7 years. And there's mathematical analytic reason for that. That's why I want you to watch that video. So let's look back at the San Jose market and what I expect. I expect 2023 to be much flatter than typical. Maybe like 2019, where we see a tiny bit of increase in the spring as supply and demand try to find a balance, and then a softening later in the year, ending the year with maybe slight appreciation, maybe slight depreciation. I don't know exactly how that's going to go because there's so many other factors affecting that. Option A I have laid out here. If we have really slow supply that continues to hold low and unemployment keeps low, under 4 or 5%, probably are going to have minimal impact to the housing market, meaning we might have a slight appreciation and probably multiple offers in that spring market. But we really got to watch the supply and the unemployment, because we do know there has been local layoffs here. But in the grand scheme of things, how big and how much has that affected unemployment is what's really going to matter, because if people lose their jobs, they might be selling their houses, which means we're going to have more inventory and there's maybe less people that can afford a home. So, the market could change and definitely soften even more in 2023. Taking a quick snapshot at the market right now, unemployment is still holding at 2.2%, which is extremely low. It's likely to go up a little bit. Will it go over that 4 or 5% threshold? I don't know. I'm going to say it's probably unlikely, but we just don't know. We've got to watch the numbers. Today, also, the days of inventory is only 35 days. Our supply is really low, just 1 month supply of homes. That's got to drastically change to get the market to shift differently. To put it into perspective, in 2007, 2008, the days of inventory was well over 100 days. I think over 150 days even in the peak. So it was pretty intense. We're nowhere near that at this point, but we've got to keep watch. So bottom line for the San Jose real estate market is the market's not going to crash. It's not going to fall out. It could be slight appreciation, slight depreciation, depending on several different factors. But what you can't control is mortgage rates, but you can control the loan that you choose that works for you. You can't control the supply and demand, but we can focus on affordability and your needs and what's going to work for you for 7 years or more. And we definitely can look forward to the market eventually reappreciating again, likely to recover in 2024 in a more positive, modest direction. So these are important factors. I really want you to stay informed of what's going on month to month. I update everybody on these numbers on my monthly market update video. So if you don't want to remember to check YouTube, sign up for my monthly market update. I'll put the QR code on the screen, and then also we'll put the link down below so that you can be emailed once a month about the market and what's going on. The other thing I really want you to watch is that Where is the Market Going video, like I talked about, to really get an understanding of the numbers and your personal plans. And the best, of course, is to reach out to us directly to have a buyer consultation to work through your plans, your numbers, what might work for you, to see if now indeed is a good time for you to buy, or if affordability is a concern, then maybe it's best for you to save up and wait. So those are important factors that only you personally can decide, and we'd be happy to guide you. We love working with you guys. You can reach me or call me at 408-839-4196. Thank you so much for joining, and I hope to keep you informed of what's going on and give you the slight edge ahead of any market changes.